Where does your rent money actually go? Think about that for a second. It's a simple question, but the answer will surprise you. The higher your rent, the more complicated the answer. This isn't just about paying your landlord. It's about money flowing through a hidden system. And once you see it, you won't be able to unsee it. We'll break it down by tiers. First, low-end rent. Think small apartments or older shared spaces costing about £500 to £1,000 a month. At first glance, this feels straightforward. But even here, rent does more than you realize. Here's where it gets interesting. At the low end, the system is stripped to basics. You might only have a few players. You, your landlord, maybe a handyman or local council. Your rent flows mainly to fixed costs. For example, property taxes. Studies show taxes and insurance can be about a fifth or more of housing costs. So a chunk of your low rent goes straight to the city or county. Then there's maintenance. In cheap rentals, maintenance is usually reactive. A pipe leaks, you call a plumber, job done. You don't have a fancy maintenance schedule. That means money isn't leaving every month. It comes out in bursts when things break. And that's exactly where the story starts to change. Now, imagine the landlord. In many low-rent cases, they've already paid off the mortgage years ago. So no bank is taking a cut. That's big. Without a mortgage, more of the rent can potentially reach the landlord's pocket. But it's not all profit. Often those old buildings have hidden costs. An aging roof, loose wiring, a dodgy boiler that pops up now and then. The rent money often goes back into those repairs. So what's left? In this tier, with so few layers, the landlord can see more direct return on rent. Fewer middlemen, bigger share. But it also means less reinvestment in the property. Paint peels, carpets fray, and the place ages. The tenant's experience may suffer, but the money trail is simpler. Mid-tier rent, £1,000 to £2,500. Now let's move up the ladder. Mid-tier rent, roughly £1,000 to £2,500 per month. Think a decent city flat or suburban apartment. Here things get more complex. This is where it really starts to branch out. The first big shift is the mortgage. Most of these places are not fully paid off, so a huge chunk of your rent goes straight to the bank. In fact, industry data show about 46 pence of every rental pound typically covers mortgage payments. Yes, nearly half. Early on, most of that is interest, pure profit for the bank, not the landlord. Next up, higher taxes. When property values rise, as they tend to by mid-market, tax bills jump too. In the Scotsman breakdown, 11 pence of every rent pound went to property taxes. So your landlord hands over a tenth of your rent to the council before anything else. Maintenance now is more scheduled. Landlords set aside funds for regular upkeep. Maybe a gardening service, annual boiler checks, repainting every few years. This means steady outflows to contractors and plumbers, not just random bursts. And here's a new player, property management. Many mid-tier landlords hire a management company to handle daily tasks. Rent collection, tenant issues, repairs. They don't do this for free. Typically 6 to 10% of the rent goes to them each month, plus extra fees when they find new tenants. So on a £2,000 rent, imagine £120 to £200 paid to a manager. That's money leaving before the landlord even sees the rest. Don't forget insurance. As values rise, premiums do too. Landlords often pay 15 to 25% more for insurance than homeowners. That can be an extra few hundred per year built into rent. So add it up. For mid-tier, the rent pound is chopped into several pieces. Roughly 46p to the bank, mortgage. 11p to taxes, maybe 10p to management, some to insurance and utilities. Maintenance and repairs take another slice. The Scotsman report estimates 93 pence of every rent pound goes to these costs, leaving only 7 pence as profit. What's the takeaway? Even though the rent is higher, the landlord's margin feels tight. More money flows in, but even more flows out in different directions: mortgage, taxes, fees. The system is layered now. High rent, £2,500 to £5,000. In a luxury high-rise lobby now, we enter luxury territory. Rent in the £2,500 to £5,000 range comes with amenities and service. Think city penthouses or big new developments. Here, Rent isn't just for a roof. It's for convenience and prestige. And this is where it really gets dramatic. The mortgage and taxes keep climbing. But the big changes are the extras you didn't pay for before. A gym isn't free, it needs equipment maintenance, cleaning, electricity. A concierge desk isn't free, that's salaries and training. A rooftop pool or valet service adds even more staff costs. Each amenity creates a new line item. The building might have a part-time mechanic, a full-time receptionist, gardeners, CCTV operators. All those payrolls, even if just a small percentage of rent in total, are new claims on your rent. In fact, in a high-rise, multiple on-site staff might account for 7 pence of each rent pound. As shown in the study, that was for payroll in general. Multiply that by all the people working round the clock. Management here is fully professional. Large corporate firms often run these buildings with dozens of people on staff, using technology and efficiency metrics. They charge accordingly. Investors also appear. At this level, many units are owned not by an individual but by a group or a public company. Rent isn't just covering costs. It must deliver returns. Institutions like real estate funds or REITs own these properties and expect, say, 5 to 7% yield. That means some of your rent is pre-allocated to meet investor targets, like dividends. Insurance too goes up. One report notes landlords pay roughly $2,000 per year on insurance, versus $1,744 for homeowners. That extra risk premium adds to cost. Utilities and repairs can be fancy, e.g., high-tech HVAC systems, each needing special maintenance. In short, at this tier, rent fuels an entire ecosystem. Big banks, huge loans, local governments, high taxes, management firms, amenity providers, and investors. By the time all costs are paid, the owner's slice of the pie might still be in the single-digit percentages. It's still the same system: banks, governments, services, but supercharged. Transition. When housing becomes a network, to camera can you see the pattern? Somewhere between £2,500 and £5,000 rent, housing stops being a straight transaction. It becomes a network. Money no longer flows one way. Instead of just tenant-landlord, each pound branches out to the bank, the council, contractors, staff, investors. We can summarize it this way. Low rent. Rent sustains just the property, taxes, and repairs. Mid-rent. Rent sustains a system. Banks, councils, maintenance companies. High rent. Rent sustains an ecosystem. Corporate managers, luxury services, investors. Re-engagement. This is where it all comes together. Your rent helps keep this hidden machine running. Ultra-high rent, £5,000 and beyond. Luxury setting or graphic of stock market overlay finally. Ultra-high rents, above £5,000. At this level, rent is almost a financial instrument. The properties here are often owned by layers of corporations. Think real estate investment trusts, REITs, pension-backed funds, or property investment firms. In other words, your rent might end up on the stock market. REIT, as Nariad explains, is a company that owns, operates, or finances income-producing real estate. These trusts pool rent payments and distribute profits as dividends to shareholders. So when you pay rent here, it flows into global capital. Mortgage financing is massive. These might be syndicated loans or even bonds. Property taxes are very high. But beyond that, amenities scale up. Rooftop cinemas, spa pools, automated smart home systems, each with dedicated staff. Some buildings even have restaurants or co-working spaces paid by residents. Every new feature is funded by your rent. At this tier, management is corporate with efficiency targets. Entire teams of accountants and lawyers manage budgets. Investors expect returns like clockwork. If rent dips or costs rise, shareholders raise eyebrows. At this level, rent no longer feels like a payment for a home. It feels like a payment into a financial network. Your money might go to local costs a bit, but it also goes into that REIT's profit pool, which then pays out to millions of investors worldwide. A tiny chunk might pay a doorman's salary, but a chunk is dividends. How £1 changes as rent rises. Let's look at it from another angle. take £1 of rent. In a cheap flat, that pound largely covers tax or repair, and maybe the landlord pockets the rest. In a mid-level flat, that same pound splits 46p to bank, 11p to tax, 27p to maintenance and insurance, leaving 7p profit. In a high-end flat, that pound might go 50p to bank, 15p to tax, 10p to management, 10p to amenities/services, and only 5p to the owner. Finally, in an ultra-luxury flat, maybe 20p covers local costs, and 80p goes to corporate/financial uses, loans and investors. So the higher the rent, the more your money spreads out. Why higher rent is not equal to bigger profit. People often assume higher rent equals bigger profit for the landlord. But that's not the full story. As rent goes up, so do costs. Higher mortgages have more interest. Taxes jump with property values. Amenities need constant funding. And corporate owners or investors will claim a share. Remember the NAA data. Even though rent levels rose, only about 7p in the pound ends up as profit. Everything else is eaten by costs. And as one landlord survey found, only around a third of landlords say they earn profit consistently year to year. Many just break even after paying all these growing expenses. So yes, the numbers on your paycheck might be bigger, but so are the deductions. Even at £3,000 rent, the owner isn't swimming in cash. They're juggling huge loan payments, hefty taxes, and new bills. The difference is scale, not simplicity. The invisible network behind every payment. Here's the big reveal. Every rent payment activates a network. When you pay rent, you're not just paying for your room, you're part of a wider system. A bank collects interest. A city hall collects tax. A plumber or electrician gets paid to fix stuff. An insurance company gets a premium. A management firm takes a fee. A REIT or investor takes dividends. Each is connected. Your rent is the fuel that keeps them all running. At low levels, you see maybe 2 connections: landlord, council. At high levels, there could be dozens. Think about it next time you swipe to pay rent. It vanishes from your account, but it pops up everywhere else. School budgets, road repairs, CEO bonuses, maintenance vans. When housing shifts from shelter to asset, there's a point where housing stops being just a roof over your head and starts being viewed primarily as an investment asset. In low rent, it's about living space. As rent climbs, especially past a certain point, landlords and investors treat it like a business. Upgrades aren't just for comfort, they're for returns. Maybe the landlord asks, "Will putting in a new dishwasher get me an extra £100 a month?"